Hello and welcome to the very first episode of the RavenPack Chat with the Experts series. My name is Ashish Sharma. I'm the head of business development here at RavenPack, and I will be moderating the session today. For those of you who might not know RavenPack, we are a pioneer and leader in the alternative data and big data analytics space with over a decade of experience in helping investment management firms deriving value from unstructured data sources. The objective of this Chat with the Experts series is to provide a forum for the audience to hear from and interact with industry experts on alternative data and big data. And the topic we will be discussing today is big data for fundamental investing, and we'll be looking at a big biotech use case. This session is co-hosted with Empirical Research Partners. Our presenters and experts today are Rochester Cahan, CFA and U.S. Portfolio Strategist at Empirical Research Partners, and Peter Hafez, Chief Data Scientist here at RavenPack. During the presentations, all participant lines will be muted. You can ask questions at any time using the online Q&A feature, and these questions will be answered at the end of the presentation. With this, I will pass it on to Peter and Rocky to kick things off.
So Rocky, thank you for doing the webinar with us. I'm really excited about hearing more about your latest research on using big data for fundamental investing. But I think this type of data is not new to you. We have actually known each other for almost a decade. You were one of the pioneers in the alternative data space, looking at our data already starting back 10 years ago. Isn't that right?
Yeah, that's right, Peter. It's a little bit scary when you say it like that. But yeah, a decade ago, I think 2009, first started looking at this data, initially trying to build some quant signals based on it. So it's exciting, yeah, to be looking at the data again, and obviously a lot's changed in the last 10 years.
Yeah, for sure. And one of the things that have changed is that there's a lot more other sentiment data providers out there that have entered the scene. So how did you go about vetting sentiment data sources and ultimately choosing one for your research?
Yeah, that's a great question, and I think that's the question that everyone has to start with when they're starting to tackle big data, because just like the name suggests, there's a lot of it out there. So our search really started with firstly just trying to compile a list of everything that's out there and available, and that list is pretty long now, as most of you know. So slide 5 here just gives you a flavor for the type of data sets that are kind of out there in this universe now. We actually started with a list of about 850 individual data sets that were under consideration. To give you a flavor for what those look like, obviously the topic we're talking about today is kind of news and social media sentiment. There's a large number of data vendors in that space now. Satellite data, very popular these days in terms of buzz, at least. It even featured in an episode of Billions. That's basically taking photos from space and counting the cars in people's parking lots and that kind of thing. Geolocation, a little bit controversial these days, but tracking where people walk with their cell phones. Did they go into a Best Buy or whatever? Web data, kind of a grab bag for anything you can scrape from the web. Credit card data, obviously transaction data from people's credit cards, trying to predict what they're buying and that kind of thing. So there's an awful lot of data out there, and so our job, like everyone else who dabbles in this space, is basically kind of a needle in a haystack problem, right? We've got to narrow down this list of data sets and try to find ones that are applicable to what we're doing, which is ultimately trying to forecast long-term stock returns. So the search process for us is kind of multifaceted. I think the first thing that we thought about was just trying to target the low-hanging fruit first, and what I mean by that is basically looking for data sets that have a reasonable history behind them, that have reasonable breadth, i.e. cover a large part of the stock universe that we're interested in, have some kind of structure to them so that the mapping issue is not prohibitive, i.e. linking the data back to an individual stock identifier or ticker, and so forth. Because there's so many data sets out there, you've got to start somewhere, and I think it makes sense to start with the more obvious ones, and certainly the social and media sentiment fit that bill. Certainly, RavenPack, for example, has a pretty long history built up now. in our own work, we've so far tested about 24 databases. This just gives you a flavor for the type of things we've looked at. Obviously, the topic today is the right-hand side of that. We did a pretty extensive body of research on news and social media data vendors. We ultimately tested 9 of those, and RavenPack was one of the ones that we selected in that space. Other things we've looked at: securities lending data. That's data derived from the over-the-counter securities lending market. So that would be like data provided by prime brokers and participants in that market on, the amount of stock available for borrowing, how much of it is borrowed, that kind of thing. Shipping data, that's coming from bills of lading, which is like the form you fill out if you're shipping something into the U.S. So that's capturing, what came into the U.S., how much it weighed, what port it came through, who shipped it, who received it, that kind of thing. We've looked at things like accounting data, which is basically like the quality of a firm's accounting as judged by the auditor and that kind of thing. Patents would be like the valuation of the firm's patent base. And then we've done work ourselves just scraping the SEC Edgar filings, which would be like the text of the 10Ks, 10Qs, 8Ks, and so forth. But you can see here a big part of our work has really been zeroing in on news and social media sentiment. So, it's a process of kind of trying to winnow it down to a more manageable universe of data to look at.
So what were the reasons for choosing new sentiment versus all the other interesting alternative data sets that you could have been looking at?
Well, I think there's a couple of reasons for us. I touched on some of them, which are the more kind of practical reasons, which is you have a reasonable history, particularly the RavenPack database. It goes back to the early 2000s. That's very valuable, given most of these data sets don't have much history. The ability to map easier to identifiers, that's obviously already done in RavenPack's database, for example. But I think more broadly speaking, one of the big reasons we were interested in media sentiment in particular is it's a good addition to a more quantitatively focused process, right? Because a lot of the data we look at in finance is numerical in nature, right? It's financial statement data, balance sheets, income statements, it's price movements, volumes, everything that can be quantified numerically. What has always been missing in quantitative models and fundamental models as well is basically some read of kind of the mood surrounding a stock. You're always missing out on the story behind a stock and what's going on in a more qualitative sense. So we've always been interested in trying to add to our process metrics that can try to quantify that. And so news sentiment is an obvious place to look for trying to inject a little bit of color, if you will, to surround all the quantitative data points that we look at. Also, the other thing that struck us with this data, which was interesting to us, is how it's different from price momentum. Because the obvious question when you're talking about sentiment data is, isn't it just the same as momentum? Isn't it just another way of measuring, the sort of market sentiment surrounding a stock, which is arguably best captured just by looking at whether the stock price is up or not? So as part of the initial process, what we were interested in doing is comparing sentiment to the performance of the equivalent price momentum metrics. And so on the left-hand side of this chart, what we're looking at there is sentiment derived from the RavenPack database, which is just looking at the average sentiment for all the stories about a company over both a 1-month look-back period as well as a 9-month look-back period. And then on the right-hand side of that chart, we're looking at the equivalent for price momentum. And what we're interested in doing is comparing the alpha of those signals. And I think what intrigued us in particular is that shorter horizons, like a 1-month horizon, a 1-month formation period. What you basically find is sentiment looks quite different from price action. And that's particularly true on the positive side. If you notice the first left-hand gray bar in that chart, on average, stocks with positive sentiment over the last month have outperformed by about 2 percentage points per year. Stocks with positive price momentum have actually underperformed. That's the third gray bar. So there does seem to be some difference between what's happening in the short term between what the sentiment of a stock and its movement in the stock market. And that's confirmed on the next slide here, slide 9. What we're looking at here is the correlation between sentiment computed over 1, 3, and 9 months, and again, momentum computed over the same periods. So this is looking at the look-back period that you use to calculate these metrics. And what you can see here is when you get to a long-term horizon, like say 9 months, so if I'm computing all the sentiment from all the stories about a company over the last 9 months, and I compare that to the price momentum of a company over the last 9 months, those two things are actually quite similar. Which sort of makes sense, right? If the market's reasonably efficient over a 9-month period, you'd sort of expect that all the important news about a company ultimately filters into the price. But what is really intriguing is once you get to sort of a 3-month horizon, and certainly once you get down to 1 month, that correlation comes down quite substantially and actually it actually flips negative on the positive side. So what that's saying is stocks with good 1-month sentiment, they behave very differently from stocks with good 1-month price momentum. So that was intriguing to us because that says this is telling you something different from what you get if you just look at what the stock is doing in terms of its price. I think another reason we were quite intrigued by sentiment is what you see here on slide 10. One of the traditional signals that we've always used in our models, and most quants and fundamentalists use in their models, is just analyst revisions, right? How much did they revise their earnings forecast for, say, the coming year or the year after that? What we actually found is if we drill down into the RavenPack database and look at specific types of stories, we can actually come up with a better, in a way, earnings sentiment measure than what we get with earnings revisions. Because one of the things we can do in the RavenPack database is we can drill down specifically to stories about companies' earnings. And that could be stories, speculating about what the upcoming earnings are going to look like. Could be also stories digesting what ultimately happened with the earnings. That's the left-hand bars there. So what you see there is you get a pretty decent spread between stocks with positive earnings sentiment and stocks with negative earnings sentiment. In other words, there's some alpha there. If you look at the earnings revision signal in the period we're looking at here, which starts in 2002, that's basically all post-Reg FD, the continuous disclosure environment that we're in these days. Earnings revisions has not been a particularly effective signal at all. In fact, it's been perverse in the sense that positive revisions have actually underperformed negative revisions. So this kind of made a lot of sense to us in that if you think about what a sell-side analyst does these days, they don't get any really information advantage because everybody gets the information at the same time. So then their job is really just taking, the nebulous flow of information surrounding a stock and trying to process that and convert it into ultimately an earnings forecast. But it seems to us that just like going to the horse's mouth and just actually cutting out the middleman, the analyst, and just going straight to the earnings news is actually a better way of quantifying ultimately all the information that the analyst is going to rely on anyway and doing it quicker. So this was another reason we were quite interested in sentiment, is that it gives us a different and better read on kind of the basic sentiment surrounding the earnings of a firm, and it does seem to have some predictive power. So ultimately, what we did with the data then was we put it together into what we call a composite media sentiment indicator. And on the left there is the data that we extract from the RavenPack database. We also used another data vendor as well and mixed that in. I won't obviously dwell on that today. So what you can see here is certain subsets of sentiment actually ended up proving more useful. And one of those we've already talked about is earnings sentiment, which gets a big weight in our indicator. We also have a little bit of a weight on what's called news flash sentiment. So that would be the sentiment extracted from shorter breaking news headlines like, Apple announced earnings beat by 5 cents or whatever, that kind of thing. The reason that gets a lower weight in our work is because we're trying to predict longer term returns rather than high frequency returns. And what you find with breaking news is it tends to be priced very quickly. So it's certainly impactful in terms of prices, but the prices move very quickly and pretty efficiently to factor in that news. So if you're trying to profit from some kind of post-news drift, there's not a lot of it. Much more useful is actually the bottom gray slice there, where we're basically looking at what's called full story sentiment. So that would be like looking at longer form news articles, maybe articles that are a little bit less quantitatively focused, a little bit less financially focused. There, the information is less quickly priced, so we do get more drift, and so that gets a higher weight in our framework. So we have found that by blending certain facets of sentiment together, we can build a better signal than just indiscriminately taking every possible news story about a company and lumping it all together. So if we do that on slide 12, basically what we find is we get a signal that has pretty decent predictive power over the period that we're looking at, starting in the early 2000s, and that predictive power has persisted in the post-crisis era, which is the right-hand bars. So on average, stocks with or stocks in the most positive quintile of this media sentiment indicator outperform by somewhere between 250, 300 basis points a year, and those with negative sentiment lag by about 350 basis points, and that's pretty comparable with the post-crisis era as well. So there does seem to be some standalone efficacy in building this sentiment indicator, and it does tell us something about the future direction of the stocks.
So far, you have focused mostly on showing results around large cap stocks, but how about mid and small caps and non-US equities for that matter as well? Is there any value in new sentiment for these segments?
Yeah, that's a good question. So we found there is in both, and pretty typical of what we find with most signals. Actually, the efficacy is a little bit better outside of U.S. large caps. Really, U.S. large caps is the hardest place to start because it's such an efficient market and everything's priced pretty accurately most of the time. So as an out-of-sample test, after we built this composite sentiment indicator, what we did was then we tested it outside the U.S. In the rest of the developed world to see if it worked there without tweaking the weights or anything like that. And the good news is it did, and actually, if anything, it was slightly better outside the U.S. So the left-hand bars here are developed markets ex-U.S. The right-hand bars here are the results I already showed you for the U.S., and they're certainly very comparable, if not slightly better in the developed markets. And I don't have it here, but similar kind of story in U.S. small caps as well. So I think there's definitely merit in applying it to other markets as well.
That's good to know. But when you look at these type of factors, I think most people are of the opinion that it's mostly for quants. But is there something here that can also be used for fundamental investors?
Yeah, so we think there is, and I think the best way to illustrate that is just to take you through a couple of examples, because here at Empirical, certainly, we don't see ourselves as, pure data-driven quants. We think of ourselves as more fundamentalists who use quant tools to try to understand the world and set some guardrails around what we're doing and try to steer us in kind of a statistically advantaged way. But we're not slave to the models, and we're quite content at times to overrule them if something's happening fundamentally that maybe the models aren't picking up on. So we have found use cases in that kind of more quantamental framework where we can actually extract quite a bit of value out of sentiment even without a quantitative process. And a good example here is slide 16. What we're looking at here is the interaction between sentiment and value. So the left-hand bars here are stocks that screen as cheap on our composite valuation factor, which sort of has the usual suspects: PEs, price to books, cash flow-based valuation, and so on. So what we're doing is taking that basket of cheap stocks and further sorting it by the sentiment of those stocks. So the first gray bar on the left, those are stocks that are cheap with positive sentiment. And the black bars are stocks that are cheap with negative sentiment. So what you're seeing here is sentiment does appear to be some kind of discriminator in separating value traps from legitimate value opportunities or turnaround stories. And you see a similar thing on the expensive side of the equation as well. So the right-hand bars, those are stocks that screen as expensive in our value framework. And one particularly noteworthy result is if you're expensive and have bad sentiment, that's a really bad combination, which kind of makes sense, right? If you're at high multiples, the market kind of believes in you. If the sentiment turns, that's really bad. Those stocks in the right-hand black bar have underperformed by something like 10 percentage points a year on average, so pretty significant. I think it's interesting to look at how all of this plays out over time. So if you go to slide 17 here, this is a little bit of a confusing chart, so I'll explain what's going on here. What we're looking at here is stocks that are value stocks with bad sentiment. Now, if you look at value stocks in general, they tend to have below average sentiment, which kind of makes sense, right? That's probably why they're value stocks, is because something hasn't gone right, and so they're trading at low multiples. So if you start with this basket of stocks that look kind of statistically cheap and have bad sentiment, then what we're looking at on slide 17 is what happens to those stocks over the next 2 years. The black bars are stocks that are cheap and continue to have bad sentiment. So say 12 months after you started, still something like 40% of those cheap stocks with bad sentiment are still cheap and still have bad sentiment. So in hindsight, you'd say, well, those are value trap stocks, right? They never turned around. They were sort of cheap for a reason because something was wrong with them. So that's a decent number. But then if you look at the gray bars, this is kind of the cohort we're interested in. These are the stocks that started out cheap with bad sentiment that have now migrated to cheap with good sentiment. And there's not that many of them, but a year after you started, you might have like 10% of the list you started with have now moved to the other extreme of sentiment. Now, the reason this is interesting is if you go to the next slide, this is looking at the 1 year forward returns relative to the market for each of those two buckets. And what you see here is basically the gray bars are buying the stocks that are now cheap with positive sentiment, and the black bars are buying stocks that are cheap with any other quintile of sentiment. And so what you see here is pretty consistently the gray bars are above the black bars. So what that's saying is it kind of doesn't matter how long a stock has been cheap. What you're really looking to do is pull the trigger when the sentiment turns. And so that's your catalyst for jumping into a value stock. So this is kind of valuable from a fundamental perspective, right? Because you can think about sort of a investment process where you've got your watch list of cheap stocks and you're thinking about, okay, these look kind of interesting. They're cheap in my framework. When should I buy them? And then you can have, sort of a sentiment metric, and you're watching for when your stocks that you think are cheap are kind of migrating up that ranking. And once they get towards the top, maybe that's when you pull the trigger. So it's kind of acting as a timing tool on top of a more fundamental measure of valuation. Now, if you think about it, this has always been kind of the basic quant setup is value plus momentum, right? Momentum being sort of the catalyst. But going back to what we talked about earlier about how sentiment is different from momentum, particularly on the long side, what we find in our work is that it's actually a little bit of a better catalyst in momentum in calling the turning point, because sentiment tends to move a little bit before the momentum does. So this seems to be an interesting combination, which obviously quants can use, but I think particularly for fundamental managers. So that's one use case I think that is quite valuable if you're a fundamentalist. The other situation where we found sentiment to be quite valuable is basically when we're looking for failure. So at Empirical, we've always had this model that we call our failure model. And you can think of it as our model that's looking for either shorts, or if you're long only, looking for stocks to underweight. So specifically looking for a list of stocks that has a high probability of underperforming the market over the next year. Now, what we look at in that model is it looks at what we would consider kind of the fundamental precursors of failure. So it looks for stocks that are trading at rich valuations, so the market has high expectations on those stocks. It looks for stocks that are having to work really hard to meet those expectations, so that would be you're spending a lot of money on CapEx. Maybe you're having to go out and do M&A to try to, bolt on the next leg of growth. You're having to finance all of that by diluting people, by raising new debt and equity and so on. And as you're starting to do that, your earnings quality is starting to slip. So that is kind of the setup that often leads to failure. And then in the component that we call market reaction on the left, that's basically looking for kind of shorter term catalysts that suggests the story's breaking down and the market's starting to second guess everything. So we've been running this failure model live in the US for 14 years now, for about a decade outside of the US. It's our highest hit rate model in live performance. And the reason I bring this up is you can see in the bottom of the chart there, we have added media sentiment to that model because of this chart here. If you take the stocks that are flagged as failure candidates on this model, those stocks have historically underperformed by about 7 points a year or so. Now, what I'm looking at here is taking those failure candidates as defined by the model and further sorting them by sentiment in the x-axis there. And I want to call your attention to the left-hand bar there. Those are stocks that screen as failure candidates more fundamentally, but still have good sentiment. And what this is saying is it's too early to short those stocks. You really want to wait until the sentiment has turned before you turn against those stocks. So I think this is a very good timing tool in trying to time when you want to get out of kind of a more story-driven, high valuation stock. You want to wait until the sentiment has turned against it. Because, even a stock with mediocre fundamentals can keep going up for a while if people still kind of believe in it. So here's a good example of where sentiment injects some additional color into our work that we can't capture with just the pure fundamentals in the numerical data. Interestingly, on the right-hand side of that chart, you can see that the combination of fundamental characteristics of failure and negative sentiment is really bad, and there's almost nothing you could do to make me touch those stocks. The odds are just too far against us.
I think you've been covering some really interesting use cases, but a lot of these use cases, I think, perhaps focus are more relevant to people that track fairly large universes or build fairly large portfolios. But what about for analysts who are doing deep fundamental analysis on a narrow set of stocks? Is there anything that they can glean from sentiment analysis?
So I think there is, and a good example and something that we looked at recently in our research is actually the biopharma space, which is a pretty obviously interesting space, and that there's a lot of moving parts. A lot of it has to do with regulatory drug approval process, FDA, all of that, particularly in the U.S. So I'll take you through that because I think there was some interesting additional information we were able to glean from the sentiment data that we didn't know by just looking at the company's fundamentals. So the first thing I'd point out just fundamentally is if we're looking at pharma and biotech stocks in the U.S., one thing that is intriguing is their free cash flow yields have largely converged over the last few years now. And if anything, actually, biotech stocks are trading at slightly higher free cash flow yields than their pharma peers, which is pretty atypical because historically biotech was always kind of the more growthy side of that industry, and therefore it tended to trade at lower yields, i.e. more expensive valuations. Why did you get that convergence? Well, here's a really interesting chart, slide 23 here. One of the cool things about the RavenPack database is you have in that something that's called event sentiment. So instead of just calculating like the sentiment for the entire, say, news story, what the technology does is actually identify predefined events that can occur to companies. And so, an obvious event would be like announced earnings or, was subject of a takeover or something like that. But there's much more detailed events that go down to the sector level as well. And so one of these events is product pricing events. So anytime a story mentions some change in the pricing of a product for a company, it could be an iPhone or it could, in the case of biotech and pharma, be a drug, that is detected, and you get a sentiment score associated with the mention of that event. So like raising price would generally be good sentiment, and cutting price would be bad sentiment. So what I'm looking at here in the gray bars is the differential in drug pricing sentiment between biotech and pharma stocks. So the big positive gray bars mean biotech companies on average had much more positive drug pricing sentiment than pharma companies. And so what you can see here is in the early part of the data, that was largely the case, right? Because biotech was bringing online a lot of the kind of exciting, innovative drugs. They were commanding premium pricing, and the sentiment surrounding their ability to control price was much more positive than pharma, which had kind of older drugs that were coming off patent and so forth. But you can see very steadily that differential in drug pricing sentiment has converged, and now it's basically exactly the same. And probably no surprise then, as that's happened, in the thin line there, the forward PE multiples of the two sectors have basically converged. So that was a really interesting way of kind of quantifying what is it that's driving some of the convergence in valuations in these two industries. And then if you look at kind of more the fundamentals, you start to see that maybe that's a plausible story, right? If you look at biotech in the U.S., it's kind of grown up now. What we're looking at here is how big is biotech relative to pharma on a number of dimensions. So if you look at, say, capitalization or earnings, it's close to about half the size of pharma. Interestingly, biotech is doing that with a little bit less R&D intensity than what you get in pharma. They're about 30% of the R&D spending that you see in pharma, while they're generating half the free cash flow. So maybe they're a little bit more efficient on the R&D side, but there has been certainly a convergence in basically what they do. And you can see that more fundamentally if you look at, say, this chart here. This is looking at the profile for pharma and biotech stocks in the U.S. in terms of what percent of your sales are coming off patent over the next 5 years or so. Very similar, that's the left-hand bars, and what percent of your sales are you expected to derive going forward from new drugs in the pipeline, and that's also very similar. So you can see that the sentiment data kind of lines up with also a more fundamental read of what's going on. How we can use this to generate alpha, I think, is really interesting. What we can do is look at how does the market price certain events that occur commonly in given sectors. And so again, in pharma and biotech, I'll use this patent news event as an example. So this is another one of the events that you get in the database. And so positive sentiment events would be things like what you see in the upper left of that chart. It would be like, Pfizer gets a new patent and so forth. And negative sentiment events would be like your patent is expiring. So we were interested in, okay, how does the market price that news on the day the news comes out? And also, what do the stock prices do in the year after that? So what you can see in kind of the middle of the chart is on the news day, yes, if you do get a positive patent approval, the stock does jump up a little bit, but not huge. But what's really intriguing is by the end of the year, so 1 year later, the stocks that had positive patent news on average outperformed their sector by like 6 to 7 percentage points. And those that have had negative patent news underperformed by maybe 150 on average. So that's a pretty wide spread that's economically significant. So that is saying potentially in this space, investors initially underprice the importance of adding to your patent base, and eventually that adds up maybe once they finally bring drugs out based on that patent. But the market doesn't efficiently price that news, and it does lead to longer term drift in the direction of the sentiment. That's a very useful thing to know, right? Because if you're a fundamental analyst covering this sector and your stock gets a drug price of a new patent approved, you might think, okay, that's useful, but it's kind of useful to know on average such stocks have actually outperformed by 7 points relative to their sector in the year after that. Another good example here on slide 27 is another type of sentiment, which is we've already talked about, product pricing news. And so here's some examples of what that looks like. So a positive sentiment example would be you raise price on your product, and a negative sentiment example would be you cut price. Now, keep in mind that is linguistic sentiment, right? So linguistically, if you're able to raise price on something, that would be considered good. What's really interesting is in the case of drug pricing, it's actually the other way around in stock price returns. So if you look at the stocks that raised price significantly, had a price raising news event, a year after the fact, they've actually underperformed their sector. And the ones that actually cut price have outperformed. Now, a lot of this has to do with the big pricing scandals that we've had with Valiant and Indo and these kind of companies, and the political kind of ramifications of just continuing to raise price. But I think the important point here is there is some nuance associated with these news events, right? It's not always the case that you necessarily want to buy things that have positive sentiment. Sometimes you need to think about fundamentally maybe positive is actually negative for actual stock returns. But I think if we go to slide 28, my broader point in all of this is that one of the things we think is interesting is in every industry, I'm sure you can find events that are underpriced by the market initially. And as long-term investors, that's what we're looking for, right? So again, to use pharma and biotech as an example, what we're looking at here is the events that lead to the biggest 1 year price drift after the fact. And there's probably like 4 events here. We've talked about a few of them. Another one would be like if your drug is given FDA fast track approval, that's been very good for 1 year ahead returns. Just releasing a new product has actually been favorable for 1 year returns. After you get beyond that, you're probably getting to less economically significant returns. But the point here is, you've got maybe 4 things you can look for in that sector that the market underprices. So you could think about, okay, if I'm covering that sector, basically, I want an alert every time one of these things occurs, and I know at the back of my mind, okay, the chances are the market is actually underpricing this thing, and all else being equal, that would make me more favorable on that stock relative to the other stocks in the universe. So I do think there is some real fundamental use case here in terms of understanding what are the real drivers of returns in a sector. Can we detect those drivers in real time and then know what the odds associated with each of those events occurring is? That's a very useful, I think, template to have at your disposal if you're a fundamental analyst covering a sector.
Rocky, that was very insightful. Thank you for sharing your research on media sentiment for fundamental investing. Let's now open up for questions from the audience. I can see a lot of questions already popping up, very interesting ones. Let's start out with this one. What does it take for a fundamental firm to start onboarding alternative data?
That's a good question. I think it's not dissimilar to the infrastructure that's traditionally been required to run a more traditional sort of quant framework, and that is you firstly need somebody who can handle the data side of things, right? So you need to be able to integrate the incoming data feeds into some kind of master database. Typically, you're going to be sucking in those data feeds from a variety of sources. Here at Empirical, we have something like 30 individual databases feeding into our master database. You need some kind of master mapping to link everything together to stock identifiers. So that's kind of like just the nuts and bolts of what you need. And then I think you definitely need people that are good at manipulating that data. But I think ultimately you need, particularly in a fundamental process, people that understand both the investment side as well as the data side. And I think often that's the missing link that we see when we're talking to our clients, a lot of whom are fundamentalists who are trying to get into this space, is you go out and you hire a bunch of data scientists that don't know all that much about investing, and they don't speak the same language as the investors, the actual more fundamental PMs and analysts. And there's a bit of a disconnect where neither side probably gets as much as they could out of the relationship, and often ultimately it breaks down. So I think one thing that we think is really important is having the link between the pure data science side of things and the folks that actually understand real world investing, how companies work, and that divide is often hard to bridge, but if you can bridge it, I think that's where you get the most benefit.
Okay, I can see another question is popping up here. How do you compare traditional fundamental indicators with sentiment indices? Are they connected to each other?
Well, I think they are a little bit, but I guess that was one of the things that we found useful about sentiment, is that it is a little bit different from the market sentiment as expressed by just the price of the stock or the price action of the stock, right? So that was the point I made about price momentum, for example. Once you get down to about 3-month horizons, and certainly once you get down to 1-month horizons, the movement in the stock's price can be very different from what the news flow-based sentiment has been for the stock, and they give you different signals. And at that shorter horizon, it seems like the sentiment's a little bit of a better signal than just looking at the price action, which is quite noisy. So we do the comparison in sort of all the usual ways. We compare the correlation of our sentiment metrics with all the other factors that we look at, both price related as well as fundamental. And then ultimately, if we're going to use the sentiment in a model, it's going to come down to sort of a regression framework where you're looking at whether the sentiment factor supplants other factors that are in the model, and whether it ultimately survives being tested against all the other factors.
There's another question here talking about different market conditions. How do you distinguish what information or big data is suitable for particular market conditions? Is it something you've been looking into?
Yeah, we have looked into that, and the first thing I'd say is it's a little bit tricky a lot of the time because you have such a short history with a lot of the big data sources that most of them actually only have history in the post-crisis era of the last decade, which has been a very different setup from what we've had for a longer-term history. So I think that's one of the reasons we like the sentiment data and RavenPack in particular, going back to the early 2000s. At least it gives us a couple of recessions to look at. It gives us something other than just a pretty long, steady bull market. Because I think particularly with sentiment, you need to test it in less favorable conditions than what we've kind of had on average over the last decade coming out of the financial crisis. So a lot of the way that we test big data sources where we can do it would be in a time series sense. How has it worked, before a recession, during a recession, after a recession? How has it worked in a value-driven market, a growth-driven market, and so forth? When we don't have that much history, we have to test it more cross-sectionally and look at how does it work in certain subsets of stocks. So is it more effective in value stocks versus growth stocks, or momentum stocks, and so forth. But it's definitely a little bit tricky to test all market conditions with a lot of the big data sources that are out there.
Thank you. There's been a couple of questions popping up that talks about or asks about the sentiment index methodology. There's a question here in terms of how you create the sentiment index. Do you build a sentiment ratio before and then use some sort of mapping to get the sentiment index?
Well, so at the company level, the way we compute our overall sentiment indicator is, in the case of the RavenPack data, we're actually taking all the events for a specific stock over a trailing 1-month window. So all the events that have been detected about that stock and all the news flow about that stock over the last month. And then we're using the sentiment score that's calculated by RavenPack, which is at a company-event level, right? So for a mention of a company and a mention of an event in conjunction, there's a sentiment score associated with that. We would basically be taking that sentiment score across all of the events for that company in the last month and basically using pretty close to just an average of that score. So it effectively becomes like the average sentiment for all the events that have been detected about a company over the last month. And we alter the weight depending on what type of story those events came from. So as I mentioned earlier, if it's a longer form article, that matters more for longer term returns and kind of a breaking news headline. If it's earnings related story, that gets a little bit more weight than a non-earnings related story. So there's some nuance underneath the surface, but kind of at a high level, that's how we build this index. So that gives us a sentiment score for each stock at a given point in time.
Perfect. There's also another question here related more to machine learning algorithms. You have presented mostly descriptive statistics in the presentation. Do you think that there's any important role of machine learning algorithms in here beyond computing the sentiment itself?
Well, I think there might be a role for machine learning in terms of perhaps doing what I mentioned when I was talking about the biotech and pharma work that we had done. One useful use case, I think, for machine learning would just be to sift through each individual sector and try to work out which events matter to longer-term returns. And we could do that manually by iterating through every possible event sector combination, and that's doable. And with computers, it wouldn't take that long. But an easier way to do it might be just to let the machines go through and say what combination of sentiment plus all the other metrics we look at, fundamentals, momentum, matter in each sector. So I think definitely in the kind of exploratory phase, there's some room for perhaps machine learning, particularly given we have so many different potential events we could look at.
There's also another question here that talks about how different sources might interact and the sentiment that you extract from it. For example, is there any insights that you have in terms of how it could interact? For instance, how conventional news sentiment might interact with social media sentiment, or versus company-produced text like press releases?
Yeah, we haven't currently gone down to that level of granularity. It's something we'd like to look at, but we haven't really gone far enough down that path to have anything conclusive yet. So I'll pass on that one for now.
We can take a last question here before finishing up. There's a question related to short interest information. If you have tried to pair sentiment with short interest or days to cover, and try to model perhaps or backtest the post earnings moves to see if there's any asymmetric opportunities here.
Yeah, we do use short interest in our models as well, but we haven't, as of yet, done a detailed study on the interaction between the two. What we've generally found is when there's sort of controversy surrounding a stock, when something's going on in a stock, if you have say a very strong view expressed by the shorts, so say they heavy shorting in the stock, generally the shorts are onto something, and you should generally do what they're doing. So in most cases you should follow the shorts. And for example, in our failure model, that's particularly true if the stock also has negative sentiment. So I think there is potentially an interaction there, and we do use both in our models, but we haven't studied that specific interaction in depth yet.
Yeah, I can also add to that. There's been some research, different research done on our data that does look at short interest information and trying to look at whether short sellers or can you say hold more information than the typical market, or whether they're just good news interpreters, and it kind of points towards the latter. So they're just generally really good news interpreters. So generally it's a good mix looking at both news sentiment as well as short interest together. Yeah, there can be some quite interesting strategies built in that. And I think with that kind of last question and answer, I think we will wrap up the the session, the webinar for today. We'd like to thank you very much. Thank you all for attending. I hope that you found it interesting and you found something that you can use in your own strategies and day-to-day jobs. We're obviously happy to help you here at RavenPack. If you wish to trial out our data, feel free to reach out to us. We will also make sure to make the recording available after the webinar, and also include the slides. But should you have any questions that we haven't covered here, feel free to shoot us an email, and we'd be happy to address it or to address them and get back to you. So again, thank you very much for joining, and I hope that you will also join in any future webinars that we do in the future. Yep. Thank you.